hang out for the end of this video and we will let you know what is the most common reason that a real estate transaction falls apart. And that can be at any point in the time. So when you purchase a home, one of the things that 99% of the time you're going to do is you're going to have a mortgage. And it's very important that when you work with a loan officer and with a bank, that bank and that loan officer know what they're doing. They're educated in the market and they understand how things work. And a lot of times, specifically in your marketplace, it's very important that the loan officer does understand. Now, I have had the privilege and the honor to work with Drew in the past, and I'm really excited to have Drew here on this video because Drew and O2 Mortgage, the company that he works with, is very focused on education and making sure that the buyers that they work with and the refinances that they do, the people understand and know more about the mortgage than when they started off with. They don't just kind of take the application and hide, like unfortunately that does happen from time to time. And so, Drew, one of the things that I really appreciated when I worked with you at O2 Mortgage was that you always understood the programs. And when we say programs, there's lots of different programs that we can use inside of a mortgage or somebody can purchase or refinance. And there's a lot of different nuances inside of each level of a program. And for you, I called you the Turk because it was like the Turkish machine, and it was back in the 1800s, right? The Turkish machine behind everything. And you were just super knowledgeable. And so it's wonderful to have you on. And so can you tell me a little bit about you with O2 Mortgage and also the company as well?
Yeah, absolutely. And Sam, number one, just want to thank you again for having me on this. Very excited, and you're always a blast to talk with. So appreciate it.
Thanks, man.
Yeah, so O2 Mortgage, we've been around since 2006, and I actually got in the business in 2006. I started with another brokerage shop doing loans, and in about a year and a half was pretty much fed up with the mortgage business, and I was about to get out of it just because I thought that it was being done incorrectly, which at the time it was, and I didn't know if anybody was doing it right. And then I got to meet Dave Setti, who was the branch manager of O2 Mortgage, and had a good conversation with him and thought, gosh, this guy's doing it right. Maybe I'll stay in. And that's kind of the beginning of it all and the end of it all. I mean, I've been with O2 Mortgage since 2008, and it's 2023 now, so I don't know what that means other than I'm old and young at the same time. I don't know.
So still young, I am experienced.
Exactly. So with that experience, in 2006, there was a lot of things going on in the marketplace. There was no talk of qualification, right? There's no talk of affordability. And it was basically, how many millions of dollars do you want? And sign here and fog a mirror and you're good to go. And today, that pendulum has certainly swung the other way. You're well aware of this, right? Now we're going to ask for not only, how much money do you make and what's your credit score, but all these other things. And it's a lot, and it's kind of intrusive. And of course, we're going to guide you and explain why we're asking for these things and make it as seamless as possible. But it's a lot more than certainly 2006. But still, there's not a lot of people talking about affordability. And that's the key that we focus on at O2 Mortgages. What does this mean to you today, tomorrow, as your family changes, as your life situation morphs, right? As your job changes, what does this mean? And so that's how we look at it. It's tailored fit for each client who's going to buy a home or refinance or do something with the mortgage. It's based on that simple principle of, is this affordable? And there's no rule like, hey, it has to be 32% of your take-home payout. We don't do any of that, right? It's tailored fit for your situation. I think, Sam, if I was going to paint the broadest picture, that's what we focus on, and certainly you're familiar with.
Absolutely. So I appreciate you bringing that up, and a couple of different things. One is I'm going to ask you a few different questions. I've got a long list of the most specific questions that come up from people when they're getting a loan, whether it's to purchase or do a refinance. A lot of times we're really mainly focused on the purchase side, but it's also important that whether you're looking to buy or to sell, that you understand the loan side of it. And sometimes it's going to be the refinance, but as a seller, it's important to understand the bank side of it because you want to make sure that the person who's purchasing the home is actually working with a good bank, a good loan officer. So that's one thing I think gets missed a lot. But I do want to ask a few different questions, and we'll dive into the questions. And again, Drew, I'm super excited that I have you on because you're so knowledgeable. And I didn't realize, it just shows how old I am. I didn't realize you've been in business since 2006. And when we put it to years, it really does make me feel much older than how I actually feel. And I look back and I'm like, oh my God, this has been so long that I've been in the business, right?
It's your knees. So that definitely means that you're in a color.
Yes. Thank you. Thank you for that. Yeah, absolutely. So one question that you just touched on is a question that comes up is, how much home can someone afford? How do they figure that out?
That there's an easy answer and a hard answer, and they're both right and they're both wrong. I would say that the most basic way you could look at it is what's called a debt to income ratio. This is the lender's viewpoint. So a lender is going to say, all right, take your gross pay before taxes are taken out. Let's say that's $10,000. And depending on the loan program, and there's many of them out there, they're going to want the total housing payment and any other consumer debts like car payments, student loans, credit cards to be about 40% of that gross pay. Be a little bit more, be a little bit less, but right around that 40% range. So if you're making $10,000 a month gross before taxes, all your payments are going to be somewhere around $4,000. Because of course, you got to pay for the Uncle Sam, you got to pay for your gas, your insurance, put money away for retirement, pay for the kids, all that stuff. So that's why they say somewhere around 40%. There are some loan programs that allow you to go up to 55, even higher percent, but it all is right around that 40%. And that's again, debt to income ratio.
Debt to income ratio, otherwise known as DTI.
Yes. And if you've got real estate and lending, so everything has an acronym.
Yeah, exactly. Everything does have an acronym. There's no question about that. So then that takes us into the next question. That would be the down payment. When you're looking at down payment, a lot of times people do have an idea that there's no way you can purchase a home or a condo, a townhouse, anything with less than 20% down. Is that true?
I would say that's probably the number one misconception out there for first-time home buyers. They think that they cannot buy unless they have 20%. And that's absolutely false. Again, there's all kinds of variations to this, but roughly speaking, on a, let's say your traditional, what 95% of Americans get, which is a conventional loan, you can put as little as 5%, even less than that in certain circumstances, and you're going to pay what's called mortgage insurance. For those who are listening here who bought a home a couple years ago, had mortgage insurance, and they're in that low 2-3% interest rate, you don't have to do a refi to get rid of it. There's a really good chance if you've made your payments on time, you can get rid of that very, very easily and very inexpensively. So reach out to me and you can get that worked out. And mortgage insurance got a bad rap because of some blemishes in the past from the 2008 crisis. But really, for the most part, that mortgage insurance today is very inexpensive. You're talking about maybe a few $100s a month. Interesting. You can get really good interest rates with that. And, trying to save up 20%, especially in the area that we're in, Sam, that might take many years where you could get a home today and not have that run up.
Yeah, absolutely. That makes perfect sense. I didn't realize that mortgage insurance had become so inexpensive. And so if you're looking at that, I think the question would be that, okay, so if I'm paying an extra couple $100s a month, does it make sense to do the extra couple $100s a month? So let's say that I'm in tech and just kind of getting started and I've got maybe 5 or 10% to put down. Mortgage insurance would be a couple $100 extra a month. Where would that pay off if I bought sooner rather than later? I kind of feel like we're going into the territory that I might answer that question, but I know you know the answer to it. So I want to ask you, how would that pay off?
Yeah, certainly you would want to talk with you, Sam, and figure out what's the likelihood of the home you're purchasing to see some sort of appreciation. On the purely financial side of it, the mortgage insurance for most loan programs are going to fall off somewhere around 20 to 22% equity. Handful of ways that most people think it just automatically comes off. There's actually ways within a couple of years without refining or doing anything, you can get rid of your mortgage insurance. So
absolutely. That's super helpful. The way I would look at it also is if you're going to pay a couple extra $100 a month for the mortgage insurance, the equity will typically in our area weigh itself out, certainly over the next, typically within 3 to 4 years easily. Will weigh itself out. So it gives you the opportunity to purchase the home earlier rather than later. Because a lot of times when you're holding on and you're saving up all those funds for the down payment, you're saving up funds. But people who have purchased are building more equity. And so it makes it much more difficult for you to balance that out. But if you can put 5 or 10% down, have a low mortgage insurance, or is this still called PMI?
A personal mortgage insurance, private mortgage insurance.
I remember hearing the PMI a long time ago, and I was like, is that right?
Well, Sam, and I was going to say, it balances it out. And, how many clients have you had are hesitant to buy because they don't have full 20%. And so they're trying, maybe they get pre-approved, maybe they don't, but they're, kind of passively looking at homes. Yeah, the market just continues to move. That leaves them behind. And it's a sad story, but we see it a lot where somebody just isn't mentally or financially ready yet, and they could have afforded a home, but now they can't.
Yeah.
I never want to say buy because, out of fear that you're going to lose out or something, but we got to look at the facts.
100%. It's a great point. And it's really one thing that I tell people over and over again is that when it's time to buy, it's time to buy. And when it's time to sell, it's time to sell. If you try to play the market only a fool plays the market. And that's really what it comes down to. If you try to play the market, you're going to shoot yourself in the foot 99% of the time. And our area moves so quickly that it feels like one day it's down and the next day it's 2 times up. And it moves very, very fluidly. And what I see over and over again is that people will keep their eye on the national market, and they'll talk to me about how the market's hurting this and that. And then you look at the local market and really focus down, and it picks up fast. And so those people who, oh, the time's not right. Well, you know what? Unfortunately, you may have just missed the boat because you didn't get your ducks lined up. And so unfortunately, that does happen in our market a lot.
Sam, not like right of a spotlight on you, but I mean, how many times looking at homes, showing homes, talking with agents, talking to your colleagues, what's going on in the market day to day, week to week, month to month, year to year, where if you're at home as a consumer on Zillow looking at homes, you've got, 30, 60, maybe 90-day delay on what's going on.
Yeah.
And then to couple that with the fact that there's so many segments in the marketplace, it's like, well, I want to buy in San Jose. Well, that's a big city, right?
Yeah. All right, big city.
What part, what price range, what home? So, I mean,
some moving parts to that.
Got a lot going on
Yeah.
there.
Yeah, absolutely. And it's true. It's just like you, the mortgage side of it, right? There's so many different nuances to what you do on a daily basis. People look across the board and say, okay, interest rates are X, interest rates are Y. Are the interest rates that simple? I guess that would be a question for you. Are the interest rates so simple that you just look and I can expect my interest rate to be here?